Hey, Cam Dunlap here. Thanks for stopping by my blog. Got some interesting information for you today that I thought would be useful. I'm sure by now you're familiar with the term Dodd-Frank. That's the law that went into effect a few years ago, but has slowly been being implemented over time. And now the part that pertains to mortgage lenders has gone into effect. And there's a few things that are, I think, notable for us as real estate investors that I wanted to just talk about briefly, and then point out some of the trends that I see happening. One thing I should mention before I go any further is that I am not an attorney and I am not an accountant. I am a real estate investor. I've been at it a long time, since 1993. So that doesn't give me a law degree, but it does give me certainly a PhD in experience. So take this for what it's worth. This is my opinion. Okay? The part about Dodd-Frank that does impact the mortgage business is now in effect, and I think we're going to see some significant effects from it that I or anybody who pays attention could predict. But I also think that, like any other massive piece of legislation, there's going to come with it a lot of unintended consequences. I mean, just Obamacare is a perfect example of unintended consequences that are starting to rear their ugly head. Well, we haven't even begun to see those with Dodd-Frank yet, but here's what I know. If you're a real estate investor and you want to sell houses using seller financing, which is a great strategy, especially if you already have long-term financing on the house and you're dealing with a buyer who may have damaged credit and who can't go to the bank. Great strategy to get a premium price for the house and nice monthly cash flow. Now you got a buyer instead of a tenant, and they're obviously going to treat the house like an owner because they own it. Well, if you're going to do that, you need to understand that does now fall under the overhanging limbs of this Dodd-Frank Act. And the way I understand it is, if you get to where you're doing more than 5 of those transactions per year, where you're creating more than 5 new notes and mortgages with buyers, or notes and deeds of trusts with buyers, more than 5 in a year, you're probably going to want to look at getting a mortgage broker's license. Well, if you're a real estate investor and you don't have an intention of getting a mortgage broker's license, that's a hindrance, to say the least. And there's all sorts of continuing education, and you've got to hang your license somewhere, and it's a big complication that I personally don't want to deal with. So I've done some talking and some exploring with my attorneys and with other friends of mine who are real successful real estate guys all around the country. And what I've kind of come up with as a solution to this is to utilize a mortgage professional as the middleman between yourself and your buyer, so that all of the RESPA disclosures and documents are part of the file, and so that the terms of this loan between yourself and your buyer fall within the guidelines of Dodd-Frank. So with Dodd-Frank, there's issues like balloon notes, or balloon mortgages. Points paid up front, origination fees, things like that, being strictly limited, interest rates, and there was something else I had on here. Where's my notes? And an affordability check. Forgive me, I got my notes right here. You're supposed to run a math formula to determine that in fact your borrower can afford this mortgage and isn't going to paint him or herself into a corner financially. So, those are things that a mortgage professional can help make sure you comply with, while sort of carrying the liability of that rather than you carrying the liability of that. So that's a solution to that. Now, when it comes to private lenders, for example, I work with private lenders a lot. I use private lenders to fund deals, fairly regularly. There again, if the lender is going to be writing more than 4 or 5 mortgages per year for you or for anyone else, that cumulative total, they technically need to be looking at getting some sort of a mortgage broker or mortgage professional license. I don't think that's realistic for most, if any, private lenders, especially the ones I deal with. So there again, I see the solution being having a mortgage professional between the lender and you, making sure that the paperwork is all done right, RESPA rules are followed. So there's a solution there. And what this means is that this mortgage professional is going to have to get paid some nominal fee to handle this, whatever that happens to be. I would guesstimate $200 to $500, depending on the size of the loan, how often you're using them, that sort of thing would be a reasonable expectation. In the case where I'm selling on seller financing, I would make that a fee that my borrower pays. And in the case where I'm borrowing from a private lender, well, I'd probably pay that fee. And just like anything else, more government regulation means more expenses passed on to the end user. It's how it always works. Taxes on certain companies or certain businesses or certain products all end up trickling down to the end consumer being the one to pay for them. That's how it works. Then there's the issue of lease options. Okay, so if you're selling a house on a lease option, you might think, well, there's no note, there's no mortgage, it really doesn't apply. And I agree. However, the challenge with a lease option is if somebody were ever to look at you and look into whether you're bumping into Dodd-Frank or not, they could take a lease option and extrapolate an interest rate if they wanted to, especially if, and this is my opinion on this now, like all of this, everything in this video, especially if your tenant buyer is receiving any sort of credit from their payment to be applied to the purchase price. So now that could really be extrapolated into a mortgage with an interest rate and a term or a amortization, because part of their payment is going to principal reduction. So my suggestion on lease options is don't apply any of the payment to principal reduction. Don't apply any of the payment to the purchase price of the house. Again, that's how I intend to move forward with lease options in light of the Dodd-Frank Act. Then there's the issue of how Dodd-Frank affects me and my business, my team in here, with the funding that we provide for our clients. So you may know that since 2008, we've been providing funding for our clients on their wholesale flip deals in the form of what's typically called transactional funding. We've been doing it a long time. We've funded hundreds and hundreds of deals, and we are very, very good at it. We're funding deals for clients every day. Today, we just funded a deal for a client in Israel on a house that he bought in the U.S. and flipped. So, we're doing this every day. And so how what we do runs into the Dodd-Frank Act became very, very important to me. And I did my homework, and when we fund a deal for you, generally speaking, and it really needs to go this way, my corporation is funding the deal for your corporation or your LLC. And what that then falls into, the category that falls into, is commercial lending. So there's no consumer involved. There's no person involved. It's one entity to another. And so that sort of commercial lending is in the fringes. However, I did more research and I came to the conclusion that the best way for me to continue to fund deals for our clients and help you make a ton of money on deals you couldn't do any other way, and not even have a chance of bumping into Dodd-Frank, was to switch my business model and actually now charge no fees for the funding. 0 fees. No application fee, no points, no interest, no prepayment penalties, no minimums, no fee funding. That is what we now do. That is our new model. Now, the way that works, you might think, well, how the heck can you fund my deal and not charge for the funding when we've been charging all along? How would you stay in business? Well, we changed the model so that Now what we do is we get an upfront setup fee. It's a nominal cost, dirt cheap, a complete no-brainer decision, and we'll fund an unlimited number of deals for you for a full year. So if we fund 2 deals for you in the next year, well, you save funding fees on 2 deals. And if we fund 22 deals for you in the next year, you save the funding fees on 22 deals. And you can see how the more active you are or become, the more you could save, and effectively the more profit you put in your pocket. And what makes it work for me is that we get this upfront setup fee. And I know full well going in that for some folks we're going to fund a lot of deals, and for some we're going to fund not so many. And so it all works out in the end. I keep my funding experts here in-house busy. I keep the wheel turning. I keep my customers coming money and being happy with our service and all of that. And you know, it's my way of dealing with the Dodd-Frank Act. And so that may be of interest to you. And if you are not part of my funding program, I would think it would be of big interest to you. And if you're currently part of my funding program, well, then we have a what we're calling an upgrade, where you can switch from the old fee funding model to our no fee funding model and get some pretty darn nice bonuses for doing that upgrade. And I would strongly recommend you give our office a call, talk to any one of our product specialists, and ask about that. So if you're new to the business, you don't know where to get your funding, well, I'm your guy, and you can watch the webinar training that I did. It's at nofeefunding.com/replay, and there'll be a link to that right below this video now. Again, nofeefunding.com/replay, where you can learn all about how to do the deals, how to whip your competition, how to find and line up your buyers so you cash out easily, and how to utilize my no-fee funding. And now if you are an existing funding client, if you're already on board, again, give the office a call and talk to one of our product specialists, and they'll talk to you about our upgrade that I think you're going to be very interested in. It makes a ton of sense to do. You can save a bundle of money by going from fee to no-fee funding, and we've got some really cool bonuses for you if you get on board. That phone number and email link are also below me so that you can contact our product specialists. So now there's one other thing I wanted to talk to you about that I think is pretty interesting that I just read about, and that is that FHA, you know who they are, they don't create or write mortgages. What they do is they insure them for banks so that if the borrower defaults, the bank gets paid off, and you and I as taxpayers take the hit. Well, they just changed their rules again recently. Now you can have a FICO score as low as 550, 550, and qualify for an FHA mortgage. Can you believe that? 550. And you know, they said the subprime lending market would never be back. Hello, I think it's back now. You know, so I think what's going on is the federal government is realizing that the Dodd-Frank Act is putting massive downward pressure on the real estate market, and will for many years to come. In fact, if you're looking to buy a house or refinance a house and you're talking to a lender now, you already know how tough that is. It's brutal. And it's because the Dodd-Frank Act puts so much pressure on the lender to vet you as a borrower that they're either not doing much lending at all, or the lending they're doing is really nasty to you, the borrower, because they're mad about Dodd-Frank and they're taking it out on you and me. I've got a friend in Georgia that told me, I just talked to him the other day, he just did a purchase and a refinance, both kind of simultaneously, and he's like me, he's been in real estate for more than 20 years. He said it was the worst nightmare he's ever been through in all the years he's been in real estate. It was awful. You know, I joke about how if you're a self-employed individual, a self-employed real estate investor, and you go to the bank for a mortgage, well, get ready, because you're going to get what I call a financialoscopy. Financialoscopy. That's if you're self-employed, and especially if you're a real estate investor and you go to the bank for a mortgage. Well, now that financialoscopy has gotten, if you can imagine, worse, seriously. And it's because of Dodd-Frank. And again, what Dodd-Frank is doing is it is putting downward pressure on the real estate market. If borrowers can't borrow, borrowers don't buy. If lenders aren't lending, borrowers can't borrow, borrowers don't buy. Yet, you've got FHA that's willing to write these 550 loans with a FICO score as low as 550. But FHA is mostly focused on lesser expensive houses, first-time entry-level type buyers, in a way to, I guess, to try to offset the impact that Dodd-Frank is having on the entire market from entry level. If you're dealing with a bank now where there is no government backing, from entry level to luxury homes, Dodd-Frank is crushing that. However, on the entry level stuff, FHA is still, pushing ahead and trying to make that work. So, also, this is a slightly less recent development, but relatively recent nonetheless, and I think notable. FHA's guidelines now allow you to borrow from them with this low FICO score, but even with a bankruptcy, foreclosure, or short sale discharged within 1 year. Now you have to qualify for a sort of hardship program and show that you really couldn't afford the house and your financial situation warranted that you defaulted. You have to show some evidence that you were in over your head, which if you lost a house to foreclosure or a short sale, that shouldn't be very hard to show. That's the one little catch on that. But now, with 1 year, where with a foreclosure or a short sale, it used to be 3, and in the old days, back when I was getting in the business, it was 7 years. Now, I've been saying for all along, since 2009 or 2010, that the only way that the real estate market would ever get jump-started again would be for underwriting guidelines to start to relax, and in particular on foreclosures and short sales, because of the millions of people who have suffered a foreclosure or short sale in those, in the last few years since I started predicting this. And sure enough, here we are, forgiveness within 1 year and a 550 FICO score. Really? So here's my takeaway, or perhaps what your takeaway might be. As a real estate investor, you and me, we'd be pretty wise to stay focused on entry-level houses. I've been teaching entry-level houses for years because that's the only place there's been any free-flowing mortgage money for years. Well, I think now, because of Dodd-Frank and because of FHA's movement in the other direction, almost a sort of equal and opposite reaction to Dodd-Frank, that entry-level marketplace remains the only real place where there's any sort of activity or free-flowing lending going on. And now, with Dodd-Frank fully kicked in, I don't see that changing for a long time. And I think all the unintended consequences that will come as a result of Dodd-Frank, we have yet to even realize. So here's my summation, and then we'll wrap this up. Stick with entry-level homes, because if you're wholesaling them and flipping them to an investor rehabber, they're sticking with entry-level homes for the reasons we're discussing. If you're a rehabber, that's where you want to be. So stick with entry-level homes. And when you're wholesaling them to investor rehabbers, which there are now bazillions of back in the marketplace, utilize my no-fee funding. It went from cheap to free. And all that means is your profit margin goes up, you become more competitive, and you're more confident, and the people that you deal with are in awe of you. And by the way, when you do utilize my no-fee funding, and someone says, "Good Lord, man, how do you have funding available to you for free?" Don't tell them. Keep it your secret. Let them know. Say, that's none of your business. Because that gives you a huge competitive edge in the marketplace, and people are going to realize that. So good for you. So again, if you're not on board with my funding program, get over to nofeefunding.com/replay and check it out. I'll teach you all about it. If you are on board with my funding program, you've been on board, you know who you are. well, then get on the phone or send an email and learn about our upgrade program that we've just created to go from fee funding to no fee funding. And believe me, you're going to want to do it. It is one powerful incentive. I mean, not just the fact that your funding goes from fee-based to no fee, but the bonuses that we're throwing in as well make it a no-brainer decision. So anyway, thanks for joining me. Keep up the good work, and let's stick with those entry-level houses and go for the no-fee funding. That's how we deal with Dodd-Frank around here, and it might be how you deal with it too. Keep up the good work. We'll talk to you soon. Take care.